G'day, welcome to the Financial Bloke Podcast, the podcast for people seeking the wisdom needed to grow their family's wealth and live a happier, healthier and more prosperous life. My name's Ben Law and I am the Financial Bloke. Welcome back to the Wealth and Wisdom Podcast. I'm Ben Law and I'm your host. Today we're going to be talking about the hidden tax trap you need to know about when buying and especially upgrading to new machinery. Every year I hear farmers and graziers ask their accountant the exact same question. If we upgrade our machinery, will that help us with our tax? And over the past couple of years, with the instant asset write-off that's been in place, the answer more often than not was yes. But with the government rolling back to the old pre-pandemic tax rules, I'm guessing that there's going to be an increasing number of producers that are going to get caught out if they don't understand the tax implications and have a good accountant to guide and advise them. So to break this down for us today is Chris Eccles, a bloke who grew up on the Darling Downs in Queensland. He's an accountant and director of his own accounting firm, Empo Accounting. I saw a video he did for all of his clients when the budget came out, which addressed this exact topic. When I saw it, I thought, this is a topic Chris and I need to dig into on the podcast. Now, before we start, we need to keep those pesky lawyers happy with a disclaimer. So please bear with me. The information contained in this podcast is general in nature and for education purposes only. It's not financial advice, it's not legal advice, it's not tax advice. You should not act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor but choose to no longer be licensed and cannot and will not give you specific or personal advice in this podcast. So now that we've got the lawyers happy, and without further delay, welcome Chris.
Yeah, thanks, Ben. Yeah, it's great to be here. It's a great podcast and what you're doing here. So yeah, thanks very much for having me on.
My pleasure. Now, Chris, where we'll start off at is for everyone listening, can you just give us a quick summary on your background, mate?
Yeah, so basically, I'm from Dalby in Queensland originally, on the Darling Downs. Whilst I was a townie as such, I lived in town, but I didn't actually grow up on a farm, but yeah, a lot of my mates did. But yeah, my father was actually a machinery auctioneer, and as a kid, I went around to all sorts of farms around Darling Downs and northern New South Wales and helped him with the auctions. Before computers, I was the runner. It was and then graduated into a spotter back in the day. And then so I've worked on plenty of farms all around New South Wales and Queensland doing auctions. But as I was later in high school, Mum told me to do accounting, which I didn't really want to at the time, but she said it would be a good skill to have. So, and here we are, I don't know how many years later, still doing it. Yeah, so I'm an accountant these days, but yeah.
Yeah, so you spent probably 15 years in the accounting game, so you know a little bit about tax, which is good. Where we're going to kick this off today, Chris, is there was a quote I saw back in the 90s from a bloke by the name of Kerry Packer, and most people should probably remember him. He was one of the richest men in Australia, and he had this famous statement he made when he was questioned by politicians about managing his tax, and it was an absolute classic. And it was, if anyone in this country doesn't want to minimise their tax, they want their heads read. Because as a government, I can tell you they're not spending it all that well, and we shouldn't be donating extra. And I think more than ever, that's probably true today. So I believe we should pay our fair share, but no more.
Yeah, 100%, Benny. I've actually got a video on YouTube with that actual quote I read with Kerry Packer, and I'm all for that as well. That he's obviously a smart man, Kerry, and 100% agree. I don't think I've met an Australian yet that loves paying tax. Yeah, there's obviously, as accountants, we can't minimise tax, but we can plan for tax and look at different options and strategies to potentially reduce tax. But like you said, as long as you're paying your fair share in tax, but make sure we're not paying more than we have to is the key to it all. And I think planning is one of the big examples of it. So, to help with that process. Yeah.
And with 30 June passing, we're in July now, and there were some fairly, shall we say, generous rules that were put in place, or changes to the depreciation rules when buying machinery. And I know that came in for a couple of years, and as of 30 June, those ended. And so we've gone back to where we were 2 or 3 years ago. And so there's this real tax trap that I think people are going to basically fall into. So do you want to give us a bit of a talk through about how it used to be, what changed, and where we're at now before we get into some really specific examples so people can understand the tax trap?
Yeah, definitely. Because obviously, during COVID, the government spent a lot of money on JobKeeper and JobSeeker and all the handouts they gave away. So obviously, the level of debt the government has got has sort of blown out, quite a lot. But one of the rules they brought in during COVID at the time, outside of handing out cash handouts, was a depreciation of equipment. So they brought in the instant asset write-off. So obviously in the last 2 or 3 years, if you buy a new piece of equipment, generally you can write it off for tax straight up rather than depreciating it. But one of the big things for that we saw with our clients anyway was that they didn't really publish it, but what could actually happen behind the scenes was that any value of the equipment you had when those rules were brought in. So say if the written down value after depreciation of the equipment that you already had might have been a couple of $100,000, we could actually write that off in one go. So a couple of financial years ago when they first brought the rules in, a lot of our clients were able to wipe off a lot of profit without doing anything, purely because of the value of the equipment that was still sitting on their balance sheet. We could write off in that year to avoid a lot of tax in that year. So over the last sort of 2 or 3 years, obviously, a lot of people have bought a lot of equipment and they can write off straight away to offset their profits and also write off the value of the equipment prior to when the rules were brought in. So it wasn't just purchasing any new equipment, it was writing off the value of the equipment you already had. So sitting here now at 30 June 2023, depending on your situation, chances are that a lot of the equipment you have is worth $0 for tax purposes. So what that really means is that moving forward from 1 July, if you sell any of the equipment that you currently have, you will pay tax at 100% on that sale of the equipment. And any equipment you buy moving forward, where you have to depreciate rather than we can't write off straight away. So what we actually find now is that in the past, if you're upgrading a piece of equipment, so say if you're selling something for 50 grand and you're buying something for 100 grand, there's a $50,000 difference there. So under the old rules in the last 2 or 3 years, you're getting a $50,000 tax deduction in that year. Whereas moving forward from 1 July 2023, you pay tax on the sale of the $50,000 trade-in or whatever you're doing there, the sale. And on the $100,000 purchase, you can only depreciate that moving forward. And generally, in the first year, it's around about 15%. So everyone's situation is different, but in general terms, it could be 15%. So you're only getting a $15,000 deduction on that, say, $100,000 bit of equipment. So your sale of the $50,000 you're paying tax on, and you're only getting, say, a $15,000 deduction. So there's a 35 grand difference there that you actually pay tax on to upgrade your equipment, as opposed to under the old rules, it was a $50,000 deduction. So you're saving tax. Whereas this way, you're actually paying, it's treated as income, really. So to upgrade your gear, there's a chance you could be paying.
You're triggering tax.
Yeah, that's right. So this is the trap with the old rules. Obviously, like I've said, in the last few years, the government's handed out all this money. All of a sudden, COVID seems to be it's still around, but no one seems to care too much about it these days. But so the government, and in particular the ATO, in the last couple of months, so it's in July 2023 at recording this. The last few months, we have seen from the accountant side of things, the ATO have really changed their tune massively. So up until probably December 2022, about 6 months ago, and to the last couple of months, they have just completely flipped. So we never heard from the ATO pretty much at all from when COVID came in to December 22, even early 23, whereas sitting in July 23 now, the last probably 2 months in particular, the ATO have been very much on the front foot, and we've even seen, handing out fines and penalties, or trying to at least anyway, and even knocking back a few extensions for lodgements and things like that. So they've really changed their tune, and they're really obviously trying to get the cash back. They've obviously been instructed to chase some cash. And this one thing here with the new depreciation rules, the media were promoting it as, it's a huge win for business. The rates have, increased to $20,000. I'm like, well, no, they didn't, because in 2023 financial year, it was unlimited. Moving forward, it's down to 20,000 because it was going to drop down to 1,000. But then during the budget a few months ago, they said, no, it's $20,000. So it's not really win. The media were saying it's win because they've increased it to 20, but that's not the case at all. It was an instant asset write-off, and they've brought it down to 20. So if you read the media, you'd probably think, oh, that's a good win, but it's not actually at all. It's quite the opposite. And this is where they're going to collect a lot of tax back in this, this one simple strategy alone by the government, the ATO. I think it's going to be a huge windfall for them, which we'll see in a few examples shortly anyway, but I think it's going to be massive for the government, for people who don't understand or don't know. So if they're trading in gear and then after the fact, if they're only going to their account after the fact, after 30 June, it's too late to put options in place to try and reduce the tax. So yeah, we'll chat about later. But yeah, if you are looking to upgrade gear and sell, in particular sell gear, you need to chat your account pretty much straight away, well before 30 June, to put things in place to try and see where you land for tax, if you need to do something or not. Yeah, to try and reduce the tax on any sale, because if you sell something for a couple $100,000 that's been written off, that's straight profit on your bottom line. So even though you might have had a rough year and had some fair losses there, but if you sell some gear to help cash flow things, well, that could put you into a profit in which, you might be taxed potentially, depending on your situation. So very interesting times ahead.
I think it is. And I think it's fairly clear to say tax is a complex area, so we need to clarify a few bits of technical jargon as we go through this to make sure we all understand where we're at.
Yep.
So the first thing is if you buy a piece of machinery and it's a business piece of equipment, you can do what we call depreciation, which means that you can each year, essentially, that machinery goes backwards in value, and you can claim a certain amount of the purchase price each year as a tax deduction for the business. And last year it was you could claim the whole lot. This year you can only claim a percentage of it. And I think you said 15%, wasn't it, Chris?
That's right, yeah. So generally, there's sort of different rules, and depending on your situation and how you operate, generally it could be 15% in the first year, and then you get basically 30% of the remaining value after that for the next few years. So, effectively, you can claim the whole lot over 5 to 7 years, roughly. You've pretty much claimed the majority of the equipment. But again, that's over, say, 5 to 7 years, give or take, depending on what the equipment is and your situation. But in the last couple of years, we could write it all off in one go. So say if you bought something for $100,000 in the 2023 financial year, you get $100,000 tax deduction straight up. Whereas moving forward,
so that's a deduction straight off your profit. You earn $200,000 profit. You take your $100,000 deduction off, which means you got $100,000 profit.
And that's right, yeah. And you pay tax on the $100,000 from there. So whereas moving forward, it's about to say $15,000 in the first year, and then it's 30% of the remaining value after that. So you're getting 15, 20, 30 grand deduction for the next couple of years, for the next 5 to 7 years, give or take. And the majority of it would be sort of written off by then. So, yeah. So you still get the deduction, but you get to claim it over a length of time, not 1 year.
Yeah. And you get from the selling the machinery, you get an income in 1 year, but you can depreciate over 5 years. So you're getting the income tax issue straight up, but the deductions over 5 years. So, but the important part is so giving the example is when we're talking about written off, when something's written off, it means you might have paid $200,000 for that piece of machinery, and that piece of machinery might still be after 5 years, say worth $100,000. But on the tax books, it was worth 200. You've depreciated it down by claiming deductions, and now on the books it's worth zero. So from a tax point of view, you've got this $100,000 tractor that's worth nothing. So therefore, when you sell that $100,000, the tax department goes, okay, well that's income for the business. So then that income then has to go in your tax return, and whatever marginal tax rate you're paying, you have to pay tax on that $100,000. And so that's where people are getting caught, is you sell this piece of machinery thinking, well, I've got a tractor sitting there worth $200,000 or a truck worth 100. I'm just going to sell it. But then all of a sudden you're triggering, because of the rules that have been over the last few years, potentially a tax issue there. And so this is sort of complicated, but we're going to go through some examples now to be able to try and simplify this down so we can understand. And I just want to be really clear with everyone is that we're simplifying things. So there's always exceptions to the rules. We're simplifying the concept and also the numbers so you can understand the concept to be able to then go back and have a discussion with your accountant. I think that's really important.
Yeah, definitely. And like I said, it's just sort of general in nature as well, because everyone's situation is different. I haven't met two people that are in the exact same situation, because you might have a lot of tax losses there. So if you did go and sell some gear, you can just offset against those losses. So because of all the gear has been written off in the past, you may have some losses carrying forward, so you may not pay tax. But again, so everyone's situation is different. That's why I highly recommend if you are going to sell some gear, go and chat to your accountant straight away just to make sure there's going to be, it's probably today's things more about letting you be aware that, there's going to be no nasty surprises later on down the track when you go to do your tax later on down the track when it's too late to do anything about. So, it's really trying to nip it in the bud and, address the issue now if there is going to be some tax on there, and chat to your accountant about some strategies how you can reduce tax if that is the case in your situation. So, yeah.
Today's episode is brought to you by AgriCoach. You've worked bloody hard over the years and you've built a solid operation. But as your children grow up and start their own journeys, you're beginning to think about the next 5, 10, and even 15 years and how to keep driving the business forward and ensure a smooth and successful succession plan. Preparing the business, preparing the next generation, and preparing for your eventual retirement all requires a solid plan and a proven process. Unsure about the right steps to take? Head on over to agricoach.com.au/webinar to learn more about our Succession Proof Your Family webinar. AgriCoach, aligning families, growing wealth, and protecting legacies. And now, let's get back to the episode. Let's get stuck in and use a basic example for us. So let's say this year you decided we need to upgrade a piece of machinery like a tractor or a grader or a dozer or a truck or a spray rig or something like that. And for this example, I'll say it's a grader. And the new or second-hand grader is worth, let's just say $500,000. So the new piece of machinery you buy is worth $500,000. And let's say you're trading in the old grader, which you've had for years, you've done a fair bit of repairs and maintenance, and it's worth $300,000. And because of the tax things you've managed to do over the last number of years, that old grader has been depreciated on your depreciation schedule that your accountant manages down to zero. So let's just walk through in very simple terms, Chris. We buy the new grader for $500,000. We sell the old one for $300,000. And just before we duck in, for anyone listening, we're going to do a couple more examples around other values, so more expensive and less expensive. So just bear with us. But at the moment, buy for $500,000, sell for $300,000. What's an estimate of the tax implications, Chris?
Yeah, so like you say, in that example, if that $300,000 bit of gear has been written off, that $300,000 is straight income. So that basically is $300,000 income straight up. So with the $500,000 purchase, so generally in year one, we get a 15% deduction on that. So that comes to about a $75,000 deduction in year one. So obviously over the next 5 to 7 years, we can effectively write the most of it off. But in year one, is $75,000 as a deduction. So I've got $300,000 income, $75,000 deduction. So the difference there is $225,000. So effectively, after the purchase and sale, we've got $225,000 that is going as profit onto our P&L effectively, and we pay tax on that $225,000 from there. So, and it really comes down to what your tax rate is on that $225,000. So, as an example, so it depends on. So, I know you've done some other episodes in structuring, which I might touch on that briefly later on. But so, say if you're trading as a trading company, generally it's about 25%. So 25% tax on the $225,000 difference is $56,000. In that classic example, if you upgrade your grader, buy a new one or second-hand for $500, trade in your old one for $300, you're up for $56,000 in tax. But it actually gets worse. So if you get taxed at individual rates, that could be anywhere from effectively sort of zero or right through to 47%. So if you've had a good year, which generally, and that's when a lot of farmers do upgrade their equipment, they have a good year, a profitable year, so they go and upgrade their equipment because they've got a bit of cash to do that. If their rate's up to 47% individual tax rate, $105,000 in tax for this particular example. Pending, obviously, that's worst case scenario. If you are in the high individual tax rates, that's where structuring is so important to try and get the right structure right, because obviously the difference between the company tax rate and your highest individual tax rate there, we're talking $50,000 in tax difference to have those different options there. So that's why planning is so important. But to give you an idea anyway, nearly the best case, if you don't have losses to carry forward already, there's a very real chance you've got at least $56,000 in tax to pay if you're trading as a company, but it's even more if you're getting taxed at individual rates. And generally with, values of equipment like that, generally it's financed as well. So it's not like you're selling got the 300 grand cash and, because generally you've probably got finance on that piece of equipment anyway, and then you're financing the new one. So it's not like there's no cash has really changed hands. So you have to find the 105,000 or potentially, or call it 56 best case scenario potentially, to pay the tax on that upgrade when you haven't actually received any cash on the whole deal anyway. But it probably gets even worse if you did have cash for that deal, because then you're 200 grand out of pocket to upgrade the piece of equipment anyway, and then you have to go and find between 50 to 100 grand worth of extra cash to pay the tax on that deal there. So yeah, and that's why I say that under these new rules going forward, this is going to be a huge windfall for the government, because of everyone's written off all their gear in the last couple of years, which has been great for tax. A lot of my clients have avoided a lot of tax because, they've bought equipment, or, we've written off the value of the gear they already owned. So tax in the last few years it's been easy as an accountant to, go meet with a client to say, hey, yeah, you've had a profitable year, but because of the rules, there's not much tax or no tax. But moving forward, there's going to be a few tough conversations around this exact example that, it's generally upgrading gear is good for tax, but moving forward, it may not be, depending on your situation. So scary times.
Yeah, it's interesting, isn't it? Because, the average person would say, well, I'm upgrading machinery. I'm having to buy this new piece of equipment. How the hell would I be paying tax?
Yeah.
That makes no sense to me. So from a common sense point of view, you go, well, why would I speak to my accountant? I bought a new piece of machinery. I don't have to.
Yep.
And the second thing is you can imagine the conversation at the end of the year when you said, I've budgeted to go spend $500,000 on this new grader. And then worst case scenario, you worked out it was going to cost you another $100,000 in tax.
Yeah.
I mean, that makes the grader really expensive at that stage, which is really tough. So I think that's great. So we've hit that one. Let's go over to something that's a little smaller. So let's say we're not buying a $500,000 piece of equipment. Let's say we've got a truck. And that truck is, say, the new truck's worth $250,000. So you're buying a prime move or whatever it might be. But the old one's worth $100,000. So you've got that $100,000 truck sitting on the books. You're going to pick up your new $250,000 truck. The old truck is fully written off. So on the books, it's worth zero. Just run us through the tax calcs for that.
Yeah, definitely. This is a pretty common scenario as well. That obviously, trucks break down a lot, and either you spend tens of thousands fixing them up, or you just trade them in and get a new one. So this is not uncommon. This example, anyway, that I've seen. So yeah, effectively again. So if you're trading in the old one for 100, that's purely a straight 100 grand income. And on the 250 purchase, again, if we're depreciating it at 15% in year one, then the depreciation on that is $37,500 as depreciation. But with the 100 grand income, the difference there is $62,500 that you're effectively profit that you pay tax on that $62,500.
So the difference between what you purchased the truck for and what you sold the old truck for.
Yeah, it effectively equates to around about a $62,000 profit, if you like, and you get taxed on that 62. And again, it comes back to your whatever tax rates you're on. So, if you're trading through a company at 25%, you're looking about $15,500 in tax to pay to upgrade that truck. But if you're in individual rates, from 34.5% to 47% tax rate. So it could be anywhere from $21,000 to $29,000 in tax to upgrade that truck alone. Massive. Like it's huge. I can't believe that there wasn't more of a media talk around this when it first came out, because they were saying how good it was. Oh, this is great for business. That you can anything under $20,000 you can write off, and it's all great. But when I looked at it and did the sums, I'm like, hang on, it's not great because moving forward, like all the equipment is worth, for tax purposes, worth zero. So obviously, a lot of business owners have had a great run the last few years with tax. We've avoided a lot of tax and written everything off, and tax has been great. That's why the ATO and the government's realised now, right, we need to start clawing that back. And if we sneak this one in and not pay too much attention to it, people won't realise. But when I sort of picked up on this, I was like, well, hang on, I'm going to be having some pretty tough conversations moving forward. So that's why I alerted my clients around this to say, hey, if you were looking to buy something, do it before 30 June 23. But again, I never say go and buy something just for the sake of a tax deduction because you're just throwing money away. But moving forward, if you do sell some equipment, let me know and let's chat way before 30 June so that we can address this and look at options to try and, potentially some strategies to help alleviate this, because if we're upgrading equipment, it's going to cost you potentially, again, depending on your situation, you might have a heap of losses sitting there that, we can just offset and it's not an issue at all. But generally, if you've had a couple of good trading years, we've probably written off all the gear against those profits. And then moving forward, we may not have losses to carry forward. And then, so trading in, upgrading equipment or just selling equipment in general, it's going to cost a lot in tax moving forward.
My statement's always been is if you are going to spend money, you should be very careful just spending money for a tax deduction. Getting the end of the year and the accountant saying you've got some tax to pay this year, and if I go spend some money, I won't have to. I think that's a really bad strategy. And the reason I usually say to people that's potentially a bad strategy and you need to think about it is because if you want to pay off debt, for example, you have to pay tax. So you generally have to pay principal off your loans. You have to pay that in what we call post-tax dollars, which you need to earn income, pay tax, pay it off. So just wasting that money is not a good idea. Now, Chris, what I want to do now, mate, is flick into something at the other end of the scale, just again to give us another example. And being a Dolby boy, you've got a cotton background.
Yeah.
And so I know these new round balers that the cotton farmers are buying now, there's a lot of bloody money tied up in them. So let's use an example now of, let's say, a $1.4 million purchase of a new round baler. Let's say you've got the old one, it's still in reasonable condition, you get $700,000 for it. So we've got 1.4 purchase price, $700,000 sale. Talk us through approximately what the tax might be, mate.
Yeah, definitely. The round balers are getting more and more expensive. I remember when they first came out, I was actually working on a mate's farm at the time, and I think they were priced about $1 million, I think it was. But they've jumped up a fair bit in price since then. That was obviously a few moons ago these days. But so again, you sell something, you trade it in or sell it for $700. That $700 is straight income, generally because it's probably been written off. So $700 income. On a $1.4 million purchase, generally in year one, you get depreciation of $210,000, which is a $490,000 difference between the sale value and the depreciation amount in year one. So obviously we can depreciate the gear, and the next few years are going to be fine because you're getting a couple $100,000 depreciation for the next couple of years. But in year one, so $490,000 goes onto your bottom line, straight profit, $490,000. So company tax rates at 25%, you're paying $122,000 in tax in this example. If you're an individual situation, so anywhere between 34.5% to 47%, but given the trading difference is $490,000, chances are you're going to be in the higher tax rates. So tax could be anywhere between $170,000 and $230,000. So given the profit's $490,000, generally you're probably going to be in the higher tax rate, again, depending on your situation, if you've got losses or not. But you can see the difference there, that chances are you're going to be up for 200 plus in tax on top of, obviously to do the trade in there. So again, company tax rate, you're paying $122,000 in tax. Personal higher tax rates, $230,000. So we're looking at a $100,000 tax difference between a company and an individual tax rate there. So obviously the big thing here is that you're paying tax straight up to upgrade your gear, which is just crazy. And the second one is, planning for it. But that's where obviously structuring comes in as well. That, if you're in a trading company or a individual rate, depending on where you are, that is a massive tax difference. And, we're talking $100,000 difference in tax, but obviously, number one, we're paying six figures in tax to upgrade that value of equipment from there. So, and, it's probably, that value of equipment, it's, probably in general terms doesn't happen that often anyway. But if you're in the cotton game or other industries where this sort of equipment does exist, it's probably not uncommon. Because if you have a good year, you've probably got a bit of cash that you want to, upgrade your equipment, upgrade your gear ready for next season, then, it's actually going to cost. Whereas under the old rules, you could probably wipe off a lot of that profit that you've made in that year, and it's a great strategy. But moving forward, it's going to cost you a lot more in tax.
It's interesting. You touched on an important point there before, Chris, is is when you've had a good year and you've got plenty of cash in the bank, shall we say, or profit, the natural inclination is to go, I'll go upgrade the Land Cruiser, or I'll buy a new tractor truck, cotton picker, whatever it might be. Yep. Very seldom do people ever look at doing it when they've had a bad year.
Yeah, that's right.
So this could be a good opportunity for families when they go talk to their accountant, if they have had a bad year, is to be able to go, okay, is there any plant and equipment that we've depreciated down to zero, or are we looking at trading some machinery in? That might be a good time to do it in a bad year. So you bring the value of that machinery into your position and soak up any losses or a lower marginal tax rate at that stage. So we've gone through those examples now, which I really think highlights that tax trap. And the way you avoid that is having the conversation with your accountant up front before you do the transaction, and definitely before end of financial year, so you can manage that transaction, because it might be a critical part of your business. But before we start to get to the end of the podcast, mate, is there any other piece of advice you can give us about, managing tax, or being more like Kerry Packer and being wise with what we actually pay to the government?
Yeah, so probably the best thing I could probably give is, obviously timing is critical with tax as well. You've touched on another episode as well later about structuring. So I'm a big believer in planning for the worst and hoping for the best. So getting your structures right. So purely, I do that, and obviously lawyers and other accountants do it for asset protection purposes, to protect yourself. But one of the bonuses of doing that is actually the tax benefits are massive as well. You can see in the examples we went through today that if you have, say, a trading company, it can potentially pay 25% as opposed to personal tax rates, depending on your situation. So if your trading entity if you're trading as a sole trader or a partnership of individuals, I would probably say, hey, go to your accountant and just say, hey, is this the best structure for me? Because it may, if their answer is just, it's just cheaper to run, just be careful moving forward that it may cost you a lot more in tax in the long run. So it's worthwhile revisiting your current structure. So, it may not be easy to move to a company or trust or something like that, but it's definitely worthwhile. Just ask your accountant the question, what's the pros and cons of your current structure? And is it the best structure that you are currently in? And if the answer is no, we'll say, well, is it hard to move to a new structure moving forward to help, obviously, A, protect your assets, and B, obviously, for tax planning as well, because, like in some of these examples here, it does make a big difference. Yeah, if you're trading as a partnership of individuals or as a company or trust or something like that. So companies and trusts are more expensive to trade under. But, we're only talking maybe $1 or $2 grand a year potentially, give or take, depending on your situation. But you can see the tax difference there alone that save the ASIC and extra accounting fees every year by miles, for the tax situation. So, plus the asset protection as well. So I know you've done 1 or 2 podcasts on structuring. So I'd say 2 bits of advice I'd tell people: go to your accountant and ask, first of all, are you in the best structure? And second thing is, if I sell a heap of gear, will I be paying tax, or what should I do if I were to go and sell some equipment or upgrade some equipment?
Perfect. And I think, just to clarify, when we talk about structures, we're talking about if you've got a partnership. So that's, the ABC partnership, or we've got a company, which is ABC Proprietary Limited, or a family trust. They're the 3 different general structures we have, don't we? And they can have what we call asset protection, which means that if someone sues you, if someone has an accident, say a worker has an accident on a farm, it can provide you a little bit more protection, financial protection for if you get sued. And then there's also the third benefit is some taxation potential management tactics that you could put in place to be able to manage that. And I think the number between, the top personal marginal tax rate versus the company rate is, I think, 22% roughly. And so if you have $100,000 worth of income and the difference is 22%, well, that's 22 grand. If it's $500,000, it's a lot of money. So
that's right, $500,000 extra. Yeah, it's 100 grand in tax straight up.
Exactly. Yeah. So it's trying to work out what is the best one for you. And I have to concur with what you said there. Is if your accountant is saying it's just the cheapest and easiest way running a partnership, that may be correct. But you should ask the question and make sure, have you got your asset protection in place? Is it going to work from a succession planning point of view? And, will it help you manage the tax as and when that does become a problem? So I think that's some great tips there, Chris. So, Chris, as we start to wind this episode up, if people want to find out more about you online or get in contact, how's the best place to find you?
Yeah, well pretty much I do a lot of videos and stuff on YouTube. So I've got a YouTube channel under Empower Accounting and Advisory. Benny might put it in the show notes somewhere. I can send you the link for that. And I've just got a heap of videos on there with heaps of tips and traps, for effectively business owners in general, which include farmers. So I do some other videos for clients I just send to just to clients, but I've got some general videos I put on YouTube. And if you like the look of those and you want to chat further, jump onto our website. So it's empoweraa.com.au, and you'll find a link to my calendar on there, and you can just book in a call and a time that suits you, and I can give you a call at the time that you put in, and we can just chat from there.
Perfect. Well, I'll put all those in the show notes just in case anyone wants them. So I think that was fantastic today, Chris. That's given us some really good examples. But above all, for me, the takeaway is educate yourself, have a good understanding from today what this means, so then you can go back and have a good quality discussion with your accountant, understand it, and get advice from them. And like all the podcasts I do, if you're not getting good advice, you don't feel like your accountant's all over it, you need to possibly find another one. So, Chris, last question I like to ask everyone at the end of the podcast is, what's your definition of true wealth?
Yeah, well, it probably for me now it's an easy one. It's having control over your time. When I was a young whippersnapper fresh out of uni, it was a monetary figure. It was $1 million. That was my goal. It was true wealth for me as a young 20-year-old. My goal was to be a millionaire and have $1 million, and then that was going to be me done and dusted. Obviously, that was a while ago, and things change, and $1 million probably doesn't really set you up very well anymore anyway. So the older I get, the more I place on time, not just time, but quality time doing things, sort of enjoy spending time with family and, friends and just hobbies and things like that. So, my definition of true wealth is having control over your time. So I ask a lot of clients, if they have a retirement date, and I'm yet to hear someone give me an actual date. Everyone says they love what they do and they want to keep doing it. They just want a bit more flexibility around their time to go and spend more time with, kids, grandkids, whatever it is, or doing things they enjoy. So they want to keep working but have more time to themselves. So, having control over that time is not around saying, I'm only working 10 hours a week. If you want to go and keep working 70-hour weeks, go for it. If that's your true definition of wealth, then perfect. But, if you want that mix of being able to work and have a bit of flexibility, having a bit of wealth and setting yourself up financially behind that will help that, because you can get managers in place and whatever to free you up so you can go and work 80 hours one week if you want, or go and do 10 hours the next, or go away for a month or two if you like. So, for me, true wealth is having control over your time, which is a whole lot that goes on behind that to reach that, which can be obviously very tough to have long term, but control over your time for me is the big one.
Perfect. It's a common theme. You'd be surprised, Chris, the number of people that have said time. And I've always noticed, mate, that when you're young, you will trade your time for money every time, hands down. I want that $1 million, or I want that $10,000, whatever it is. You will trade every last piece of your time to get that money. And I was the same when I was younger. I worked my guts out to get where I did. And as you get older, you start to realize how valuable time is. And the older you get, the more you'll trade money for more time. So you'll pay people to do things. So I can think about, a lot of farmers and graziers I see when they're younger, they'll just do everything. They'll be a jack of all trade. They'll work from dawn to dusk. And then as they get older, they all of a sudden start to say, bloody hell, I'm then more comfortable to pay people to do things. So is my time worth more than, $30 an hour? If it is, I'll pay someone to go do that job. And so time does become important at that stage. So I think that's a great one,
Yeah,
Chris.
Definitely. And and that's a great example that, is your time worth $30 an hour, when you could be off, spending time with the kids or grandkids, or out, playing golf or fishing or whatever it is. It gets to a point where that answer is no. And that's when you probably know you're getting old. So, that's why, talking about, you're a big believer in off-farm investing, and that's what off-farm investing can provide you, give you that extra income stream to help you make those decisions to hire those people if you've got various sources of income. So,
But also too, this is a prime example of what's your time worth. So if I was a farmer sitting there and I went, I'm way too busy fixing the fence to go see my accountant to do some tax planning. And then on that even the first example we did, and we said, well, I could go fix that fence or I could go talk to my accountant. So that fence fixing's like let's say $30, $50, $100 an hour. Well, if you go spend an hour with your accountant and figured out the tax implications, in that first example was anywhere from $56,000 to $100,000 for that hour's conversation.
Yep. Yeah.
If you could manage it. So it's about working out, what's the best use of your time, not only from a lifestyle point of view, is it better to spend that time fixing that fence or with my grandchild or son or daughter or partner, but it's also from a business point of view.
And that's right. That's moving from a worker to a manager. And, a manager would be spending the time managing the farm and, say, seeing the accountant or other things like that is being a manager, building up so you can manage the farm rather than working in the farm. So, there's obviously a process to get to that point, but, that's the decisions that you need to make, and what is the best use of your time. If you have a smaller operation, chances are it's probably go and fix the fence because there may not be tax issues. But the bigger operation you get, then you turn more into a manager and, hey, let's go see the accountant or the lawyer or whatever it is, financial planner, to get things sorted.
Awesome. Excellent, Chris. Well, mate, you're a great communicator. Thank you so much for giving us those examples. I think it's clear as muddy water, but we know exactly what we need to do. So I really appreciate the time, mate.
No, hopefully it made a little bit of sense, mate. But again, thanks for having me on, Ben. It's great. We've obviously known each other a while now, and I love what you do and the advice and the tips you give on your podcast. A very valuable resource to farmers, and not just farmers, but even just general business owners. They can equate that to a business. A lot of the tips that you're providing are, the general business owner, not just for a farmer. So, mate, well done. The podcasts, I'm sure they're a big hit. And I'm sure plenty of people are getting lots of value out of them. So well done.
Well, if you found today's podcast valuable and you think your family and friends or just other rural producers out there might want to avoid the tax trap Chris and I ran through, then please share and like on the socials, or maybe even just text one of your friends with a link to the episode. And as always, thanks so much for investing your time today. My name's Ben Law, I'm the Financial Bloke, and I'll see you in 2 weeks' time.